Hey guys, in this video we'll be looking at inefficiency slash gap slash imbalance, right? So what is imbalance? So imbalance is basically an area where there is unequal trading taking place, where there is more buy or only buyers and only sellers in the market. In this case, only buyers, right? Notice Notice how this candle right here starts with no wick, 0 wick. So that means that there was no sellers actually pushing the market down, right? It was just pure buys, right? So most of the time this right here breaks structure. So most of the time you see these momentum candles, they break structure, right? And most times they leave inefficient pricing, right? So the distance between this wick right here and this wick, between here you have an imbalance or a gap. Or you know, like when the market opens, like after the weekend, you see a gap that you can see physically. It's basically the same thing, right? So there are only buyers in the market right here, right? And when that happens, the market needs to come back to actually fill this gap, right? So it, unlike other blocks where it can actually test the 0% and mitigate, right, or the 50% or whatever, with inefficiency it is ideal that the market fill 100% of the gap, or 50%, not the 0%. Once it hit right here, it is not filled, right? So if I should pull my 50% tool right here on this inefficient area, notice the market came back to 50% right here and mitigates, right? So you can use inefficiency as as entry technique, or you can just use it as a point of interest, right? And on, just like with other blocks, you need to be following the trend also, right? So more of continuation than reversals, right? So as I said before, these gaps need to be filled when you see them in the market. And for this inefficiency right here to be valid, you must have an aggressive um, candle that breaks structure. That is my rule, right? It must break structure. The more aggressive it is, the more valid it is, right? Because there are more orders to be accounted for, right? So there are more buyers than there is sellers, right? And the market need to come back to actually even out, right? So it can be evenly distributed between buyers and sellers. So that's why the market came back here and mitigate. Notice when the market came back, it pushed to the upside, creating an order block, and also it left inefficient area right here. So this could have been another entry opportunity after the market mitigated, right? There is a ton load of areas where you can identify inefficiencies, right? Look at this area again. So we had this breaker structure, and remember, we're following the trend, right? Market pushed to the upside, and then we left inefficiency right here, or we left a gap, right? Look at that, 50%, right? And it doesn't have to be 50%, it can fill the gap completely. All right, one thing to note, guys, so if you have a inefficiency and a order block at the same place, right, I'm going to show you how to draw that point of interest. So let's look at this example on gold. All right, so this was a huge drop on gold, right? It was a huge drop. So we had the market right here, took out some liquidity from this equal high, right? Boom, created this order block basically right here, and then boom, the market fell and break structure, right? But then we had this huge inefficiency right here, this huge gap. So normally when it's like this, the market normally plays 100% of inefficiency or the order block. So you have to draw your point of interest like this instead of using the 50% of the inefficiency, because most time it will actually go back to where the order block is. In this case, we can say we play both inefficiency because we close the gap right here and then we still mitigate from the order block. So that is how you would draw it. And notice over here how the market does tap inside and then push to the downside. You can also refine this entry by maybe going on a lower time frame, right? All right, so on the lower time frame, this is what we see right here, right there, right? And notice market just stop right inside that little area right there and then push to the downside, right? So there's a ton load of examples that I can show you, but we'll do more of that in our chart breakdowns, right? We do more of that in our chart breakdowns. So that's basically it for inefficiency, a very short topic, right? That's basically it. I want to show you guys another example where you have a inefficiency on a order block at the same place. Alright, take for instance right here. So we have this order block right here that mitigated from over here, right? So we mitigated from over here, so money got transferred into this order block, but notice we had a inefficiency also, and this actually broke structure, right? So we have a break of structure right there. Remember the rules, whether it be a order block or a inefficient area or a gap, whatever the case may be, you must have that violent move, right? So you must have that violent move to signify that, hey, there's a lot of liquidity here in the market and there are manipulation, banks buying to sell or sell to buy or whatever the case may be, right? In this case, they bought and sell, breaking structure, right? And there's a lot of sell right here. There's only sellers right here and no buyers, so we need to even out that, right? So what the market did, would have had a point of interest like this, right? We will have the point of interest like this on a 1 hour time frame, because we need to come back to actually account for these buy orders, right, or close these positions and then push down. And that is exactly what the market did. So in this case, you would not use your fib to get 50% like this. You would probably get stop out, or you'd be way in drawdown, right? So always remember, once you have a order block and a inefficiency, always use the point of interest like this, so the market can actually play 100%, because either way this inefficiency would be getting filled, right? So it can be filling 100% of inefficiency plus mitigating the order block also, and then market push to the downside. So